Hey everyone, how's it going? Welcome. We just got the closing bell for Wednesday, October 2nd. Sorry I haven't been making the videos the last couple of days. I was traveling. Now I'm back. I'll be here through the rest of this week. I'm going to be traveling here and there over the next few weeks, but for the most part, I should be here to do the analysis. So let's take a look at what we missed and what is going on. So today, the S&P, we'll look at the SPY. You can see that we started down and then we had an upward bias for the rest of the day, but really after 9 a.m., we really just chopped sideways. So this might have thrown people for a loop right here. This is a little bit of a bear trap. We had a lot of news overnight. The Iran sending missiles, shooting missiles at Israel. We had a strike, a port strike happening in the United States. Both of those things threatening to potentially interrupt supply chains. And of course, that would send inflation back up. So we had a little bit of fear of that going on. Let me see. Should be looking at this one. So yesterday was a down day. We had a high volatility. Volatility spiked up. That caused us to move downwards, and then we recovered some. But in the end, we kind of just chopped sideways from this lower level right here. Today, we had a little bit of the opposite. We came down and then traded up, undoing some of that. So it looks like the market is mostly shrugging this off. It's going to take more catalysts and continued news in order for the market to really start reacting. So what that tells me is that for the most part, the main focus is still uncertainty surrounding the elections. We did get a VP debate last night for the US candidates. I don't know how well followed it was. I don't know how much people are paying attention to that in terms of the elections, because obviously it's the vice president's debating, not the president's debating. And it's pretty unusual to see vice presidents debating. The focus tends to be by far more on the presidential debates, but because this time we're not expecting another presidential debate, then maybe it was better followed. But in any case, it didn't really give us a lot of directionality. What we will see is if the sectors start changing over the next week, then we'll be able to start drawing more conclusions. Since we didn't get an immediate reaction out of the markets, we want to give it a little bit more time to see what we can glean off of that. Importantly, though, is that VIX is elevated. We are now at 18.98. Yesterday, we ended at 19.27. So we're in this 18-19 region. If we pop above the 20 and start going to 21, 22, 23, then we're going to know that the markets are really not liking what is going on, and we will start to see the S&P 500 start to move downwards. If you're in my Telegram channel, you know that on Monday night, I sent out a message commenting on the VIX. Was it Monday night? It might have been Tuesday morning, Monday morning. Let me see. It was, oh, it was the afternoon. It was the afternoon of September 30th. So that was Monday afternoon. I was in a different time zone. That's why I thought it was at night. But in any case, I sent out a message regarding VIX and VIX traders and how they were pricing in a move in the short-term VIX between now and this upcoming Wednesday. They're pricing in a movement up to at least probably about 20. And we got to 19.8, I believe, yesterday. What was the high yesterday? Oops, I did not mean to do that. Let me delete that. Okay, and then we made it to a high of 20.73. So we actually hit that target, but most likely because the way that VIX options work is they are European style. That means they cannot be exercised before expiration. They can only be exercised on the date of expiration. That prevents any type of arbitrage. And that means that the people who hold on to those options really do have a conviction. They really do have a strong opinion as to where that is going to trade. So because we didn't see zero options, like we didn't see everyone closing all their options, then they're still hanging on to them. So there's still this viewpoint that by next Wednesday, we are going to have volatility at least 20. So that is telling me there's a little bit of a magnet drawing us upwards into this higher volatility region. And that is going to add an element of uncertainty to the markets. And there is going to be more of a bearish lean to the markets. We can see that we made this high up here. This was 574.71. I was talking about all last week how 575, maybe 580 would be the top of as about as far as we could go after the Fed announcement over here. And then we could expect to see some chopping back and forth. And so far, we did come back down. We did touch this EMA 20 today. And that is more of a choppy movement. I wouldn't really call that. Well, I guess it is a mean reversion. But we could come down even further down to MA50 and chop in this wider region until we get to the elections, or we could chop in this short, small region. That 575 level, 580 level is still good. If we do make a bounce from here and go higher, we can still expect it to be fairly limited, not really to go above 575, 580. That would still be considered a choppy range. So we're not going to expect these huge moves unless, more likely than not, if there is a big move, it's probably going to be to the downside, because what are we going to say to make this market go higher? We've already given a 50 basis point rate cut. We've already given amazing GDP news. We've already given strong earnings from NVIDIA, from Google, from all these companies that were highly followed in these markets, and the markets just haven't gone up. They've kind of sort of gone up. We can't really say they've moved significantly higher. So there's probably not much that we could say, or not much that could happen in this world that would actually make it move significantly higher than 580. But there is plenty that could happen that would cause us to drop. Any sort of unexpected black swan event, war breaks out even more, a nuclear event happens, another pandemic happens. There's so many things that could happen that could start to shake confidence in this market and pull us downwards. So given that, we just want to be very careful. We want to keep our portfolios fairly neutral, and just understand that there's just not that much upside before the elections, and there's probably not much downside before the elections either, but there could be some unforeseen events that do drive us further downwards. We're talking about the overall markets here. There may be certain sectors that are different. If we start to panic, do we go into consumer staples, defensive sectors, or do we leave the entire stock market and go into things like bonds? Do we leave bonds completely and go into gold? Do we leave everything completely and go into some super safe haven assets? Then, or go all cash? That is possible as well. So we just need to see the degree of panic or the degree of bearish sentiment that comes into markets if one of these events happens. And of course, for now, the higher probability is that we're going to chop sideways. So we're not expecting one of these black swan events or one of these larger events that might move us downwards, but we do want to have some sort of preparation, just some sort of awareness that it could happen, and that the likelihood of a downside move right now is higher than a choppy sideways move. So let's take a look at our sectors. Let's take a look at our momentum, because that might give us a clue as to if there is a leaning one way or the other for one of the candidates, and what sectors might do well going forward, but also help us decide just how much bearish sentiment might start to develop inside the market. So let's start with our momentum levels. We'll go over here. We'll take a look at my 90-day highs. I'm at 150. And then 90-day lows, 26. So 90-day lows have been really low for a very long time now. So usually we want to see it a little bit more balanced, but it's staying at such a low level is just increasing the potential of this number to go higher. It can't stay in the tens and 20s forever. It's got to, at some point, it does have to move up to 100, 200, 300, 400 before a bounce. That it will happen. It's just a matter of when. And we've been at these double digit numbers for so long that the likelihood of it happening is increasing. So if I go a month ago, we were at 13. If I go to, let's say, well, if I go a month ago, that's roughly 22 days. That was at 26. So if I'll just move by fives. So if I go 15 days ago, we're at 48. If I go 10 days ago, we were at 8. And then if I go 5 days ago, we're at 33. And then, of course, today we're in the 20s. So for the last month, at least, we've been at double digit numbers. It's a very extended time for that to be there. So let's take a look at where we were on Friday. I think 3 days ago, 4 days ago. 4 days ago, probably Thursday. Yeah, Thursday, we're at 275 on the highs, 204, 223, 147. I think that is, oh, one more day, and 150. So we have a slow downward trend in the 90-day highs, and we're flat in double digits in the 90-day lows. We're not seeing a lot of momentum in this market. It's choppy. This is telling me it's choppy. This, I could have told you from the price chart that is choppy. It is leaning slightly downwards. So the momentum is just not there for either direction. And we are going to need some sort of catalyst to get us moving, to get our momentum back. It needs to be some sort of push. Otherwise, this is just going to very slowly roll. If we look at our momentum over here, see the number of stocks trading above $2 and have been trading for at least 6 months. We've got 57% above their 200-day or 50-day moving average and 59% above their 200-day moving average. That's not bad. That's not bad at all. And so nothing immediately concerning about that. And then let's take a look at our different sectors. So we really want to see in the 50s over here, everything is looking fairly healthy. So the only thing troubling me though is that we hit all-time highs and we're backing away from all-time highs. So it would be a different story if we were still swinging upwards. So now that we've hit that all-time high and we've kind of reverted back to that EMA 20, we need to see it, really see it bounce. We really need to see it come back up. Otherwise, all of these numbers are going to start slipping downwards. And we can see that in the last 20 days, so roughly 1 month, our consumer staples have not done very well. Our healthcare hasn't done very well. Our real estate hasn't done very well. And even our financials are okay, but not great on that time frame. The interesting thing is that those are the more defensive sectors. So there did seem to be a little bit of a bid over the last 20 days, so a little bit more of a risk appetite, but we can really see that that is waning in the last week. That this EMA 20 is going to be fairly significant, fairly important. If we can bounce off of it, if we can continue this bounce tomorrow or Friday, then our chances of staying up here and chopping sideways or moving to that 575 or 580 level increase. But if we break through here, then we're probably talking about a larger range chop. There's maybe all the way down to that MA 50 and then we'll chop between that MA50 and the 575 level. So we'll just have to see how the next 2 days happen for us. Let's take a look. I think that's about it, actually. That forms a pretty clear picture. And let's just take a look at our charts for all of the sectors, and that'll be it. Utilities looking amazing. They're great. These are doing great. So interest rate sensitive, these are doing amazing. Silver looks like it might have be catching a bid over here, but it has to overcome the current levels. There is a resistance right here. Gold is on a run. As long as it can clear the previous high right here, it'll be just fine. I'll keep on going. Home builders stuck in a little bit of a rut the last 2 weeks, probably facing a little bit of uncertainty because of the things that are happening in China and then the strike. And then, of course, what's happening in the Middle East. Defense is going in a nice upward trend, and the news over the last couple of days is probably just going to allow that momentum to keep on going. So far, ITA, XLU to the upside, gold, those are all looking very strong. XLC is looking pretty good, actually, surprisingly, but it's been doing very well the past couple of months. It's definitely been on the leading edge of the tech sector. So XLC is looking pretty decent. Real estate pulling back. We would want to see a bounce before we got interested in that. QQQ is not looking like it. We would really need it to break this 498 level, 497 level before we felt too good about that. And then, of course, we want to see the SMH level as well. We've talked about 260, 265 in SMH for some time. So when we get to SMH, we'll look at that again. XLI is actually doing very well. Financials flat. XLY, consumer discretionary, pulling back. It caught a bid because of the FOMC rate cuts, but now looks like we're pulling back from that. Dow Jones sideways. XOK not looking great, pulling back down. It just barely made a higher high over here, and we'll see. We'll see if it can bounce and make another high. Staples pulling back. IWM pulling back. IBB, which is biotech, pulling back. Basic materials, maybe a little bit of a mean reversion. It might be okay, but not nearly as good as the ones that we've already checked. The XLH pullback, we're probably not going to see interest come back into the XLV, healthcare sector. Probably not going to see interest come back until we start seeing blue chips doing well. So until the Dow Jones can break out of this sideways range and move upwards, we're probably not going to see XLV move upwards. Also, bonds still floating downwards, which is interesting because we got a 50 basis point rate cut, which should make these bonds go up, but they're going down. Biotech, we already went over. Retail, choppy sideways, not looking great at all. And energy has been going up because of the conflict in the Middle East, but it looks like that we would have to see. If we get more news, then yes, it'll keep on breaking out. But if it looks like things settle down over there, then we'll probably start reverting back and start going back downwards. So far, I guess, all in all, we only kind of liked XLI, XLC. Oh, we forgot SMH. So SMH, yeah, it just matched this high right here. It didn't make it up to this gap. It started to pull back. So that's not looking great for SMH, QQQ. If QQQ doesn't do well, it'll probably drag down the SPY. So it just doesn't look like, again, that there's a lot of upside to the S&P 500. If SMH was able to break out, QQQ was looking good, then we would have a lot more confidence in the S&P 500, but it's still the same 575 level, 580 level are what we're going to pay attention to. And if we're going to go bullish, utilities look beautiful. Gold is a safe haven. Defense is in focus right now because of the conflict, and communications. Those are the only ones that look halfway decent that I might consider going long. And of course, take your pick for the shorts and just the balance out. Make sure your portfolio is relatively neutral. You can lean it slightly bullish if you really want to. I just don't see a lot of potential upside in the short term. And then you can lean it slightly bearish. We don't want to go full on bear. Again, we're not bearish on the market. We're just saying that it's most likely chopping sideways. And we won't be really bearish on the market until we break below that MA200. I think that covered all the sectors. Yeah. So that's going to be it for today. Just make sure that right now is an interesting time period. You probably don't want to take risk to the downside, meaning that you don't want to allocate a lot of risk if things fall downwards. If the S&P goes down, you don't want to be losing a lot of money. And if the S&P 500 goes up, okay, well, you probably have a fairly limited upside. So basically that means avoid just straight calls in most things unless they're in the sectors that we identified, because the upside just doesn't look that great. And then if you have a black swan event and we have a gap down, you could suddenly lose quite a bit of money. So you want to protect yourself to the downside. So that's it for today. I will see you guys tomorrow. And because for me, it was such a short week in terms of putting out videos, I'll probably do a video on Friday as well. So that way we'll have at least 3 of these sessions this week. Have a wonderful rest of your day, and I will see you tomorrow.